Hello guys, my name is Raymond. I am an independent equity research analyst and welcome to my channel, The Bunker. So if you watch my first video, then you know where I stand regarding the valuation of Alphabet Inc. And I will give you a brief summary for what I said on the first video. So my first video, I said the following. One, that Alphabet Inc. was currently undervalued because the current market price was not justified by fundamentals as far as I'm concerned. And the price that I found representative of the fair value of the company was around $1,382. Now, for my earning per share growth for the year 2019, I forecasted it to be around 15%. Now, so in the first video, I said that Alphabet Inc. was currently a good investment based upon my perceived undervaluation, but I didn't attach any investment horizon to that recommendation. And that's the reason why I decided to make this second video to share my views in the short and medium term for Alphabet Inc. Over the short run, in this given case of Alphabet Inc., between 1 to 3 years, a revenue growth rate between 10 to 20% is achievable. That growth rate will be driven by non-US market and increased penetration of that market by Alphabet Inc. Looking at the competitive tension within the US market, it will be very difficult to expect an exceptional revenue growth rate to come from that market. Revenue growth rate, especially the advertising revenue growth outside the US market, will be the leading force of that revenue growth. Now, looking at the revenue structure, a segmentation between advertising and non-advertising revenue, we can see from the chart that advertising revenue still represents a significant proportion of revenue, over 80%, and I do not see the key in revenue growth over the short term coming from non-advertising revenue. So the advertising revenue will still be the significant force in driving revenue growth rate, and that force will be led by an increased penetration or an increase in importance of revenue growth generated outside of the United States. Now, after my first illustration, you might want to know what are the impacts of that short-term revenue growth forecast on the earning per share growth, and that's why I will take you to my next slide. Now, I want to take you to this chart, core gross margin strength analysis, where I try to understand how the growth margin will evolve with time. So what I want you to focus your attention on is this red and yellow line. The yellow line represents the cost of revenue trend growth, and the green line represents the revenue growth. Now, if you look at the relative steepness of both lines, we can clearly see that the cost of revenue growth line is steeper. The trend line of the cost of revenue growth is steeper than that of revenue growth. It simply means that the marginal contribution of a revenue growth to the earning per share growth should be expected to decrease with time, unless the revenue structure changes to make each additional unit of revenue growth generated cheaper than the previous unit, which I don't see happening in the short term because of the migration of the advertising target from the cheap platform to the dear platform. Now, done with the shorts. What are my views for the short term? We've seen that each incremental unit of revenue growth has become more and more expensive, and that was evidenced by the relative steepness of the revenue growth trend line and the cost of revenue growth trend line. It means that the marginal contribution of each unit growth to the earning per share growth will tend to decrease with the time, unless the company can implement a strategy strong enough to change the composition of revenue to make the cheaper side of revenue the major proportion of the revenue growth. Now, for the second point regarding the non-advertising revenue, I personally do not think that non-advertising revenue can be the major source, the catalyst of exceptional revenue growth in the short run. Advertising revenue will continue to be the major source of revenue growth rate in the short run by a strategy of expanding the market outside the United States, and that those factors will contribute to make the growth of earning per share in the short run moderate. Regarding my provision of the medium term, I expect advertising revenue to decrease in importance as far as its contribution to the earning per share growth is concerned, because of many reasons as the market saturation, and I expect the non-advertising side of the business to pick up enough to be the catalyst of not only revenue growth but also earning per share growth. Alphabet Inc. is invested in many projects, and one of the main projects right now, the one that is the center of attention, is the Waymo project in the autonomous driving market. That market has the potential to completely change the profit universe for the next 10 years. Alphabet is considered to be one of the leading companies in the industry. They are expected to play a major role, and pending a success in that market, we can expect significant price appreciation and earning per share growth in the future. So to conclude, I would like to recommend buying Alphabet shares, and that for many reasons. First of all, for my perceived undervaluation, I believe that company is currently undervalued, and the second reason is that I believe there are still room for growth in the advertising business, and finally, because I believe in the medium term, the non-advertising side of their business, especially their Waymo project, will play a major role. I mean, the smarter move would be to keep that company or to buy its share and to adapt the position based upon the quantity and the quality of information that we receive regarding their autonomous driving business, which I believe will play a major role not only in the price appreciation of the company, but also in the revenue growth and its contribution to the earning per share. That was the end of it. If you like, subscribe and see you on my next video.